Okay, hello everybody. Welcome to Korean Atlanta Mentorship. This video was inspired by an Atlanta news station who did a slick tribute to Notorious B.I.G. about 7 years ago. So I figured, why don't I just talk about Notorious B.I.G. and maybe velocity banking and kind of relate the two, right? With the wise words of Christopher Wallace talking about how there's more money. If there's more money, there's more problems, right? And if you don't know velocity banking, now you know, right? So you know the funny thing is, I was never really a big fan of rap growing up. But even if you weren't a fan of rap, like you knew these people were icons, kind of like Bruce Lee, right? Like if they pass away at a young age, you still remember 20, 30 years later. I feel like our society has kind of like doesn't have icons anymore. Kind of like we don't have movie stars. Like people go to the movies to see Captain America and not Chris Evans, whereas it used to be the other way around, you know? But all right, so let's get to the point. Let's talk about why more money equals more problems, right? And I don't know if you ever heard of something called Parkinson's Law of Money, but basically, the more money you make, the more money you magically spend, right? That's one reason why more money, more problems. But I don't think that's what exactly what Notorious B.I.G. was referring to. But there are tons of studies out there that show that a lot of people who make six figures are living paycheck to paycheck, right? So why? And here's the funny thing: because of this channel, so many people have sent me their budgets and spreadsheets, and they're like, "I make more than six figures, and I can't understand why I'm broke." Right? And the number one reason why you're broke is you have too much debt and you're engaged in something called segregation of income. What is segregation of income? It's basically your paycheck comes into your checking account and then it gets split all over the places because of your debt, right? So if we have a lot of debt as we make more money, it gets split all over the place, and then we're making minimum payments on everything. Yay! Why don't you have a little bit of savings? Hey, put something in a 401k. Whereas the what we're going to talk about today is velocity banking, and what does velocity banking talk about? Putting all your money in one place. So again, for the majority of people, they make more than six figures, there's at least a 50% chance that you're going to be broke. Again, more money, more problems. Unless you know this thing called velocity banking, right? So, what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. A line of credit, right? And, I am just going to brag a little bit because I want to. I'll brag until I get bored of bragging. But I literally paid off my mortgage yesterday. I called the bank and I was like, "Please make the final payment." And I was like, they were like, "Ooh, the final payment." You could tell they were impressed. Or maybe I'm just imagining it to stroke my ego. But yeah, I made the final payment of my mortgage yesterday and I paid it off under 3 years, right? And so what we have to do is we have to learn how to pay off our debts quickly using our line of credit as our main operating account. And I always emphasize a couple of things because I get the same complaints over and over again in this channel. The people are like, "This is so unrealistic. Who has a line of credit laying around for you to use?" And that's why I say that you need to get it before you ever need it because banks in general don't lend money to people who need it. I'm sure there's some exceptions, but you want to build a great foundation, and velocity banking is not an income generation strategy. It's a cash flow management debt payoff strategy. That's the other thing too, because you can't get debt unless you make money. I mean, think about if you were the lender. Would you lend to people who needed money? Probably not, because you want people who have money but are kind of somewhat bad at managing it, but not to the point where they can't pay you, right? So that's pretty much what we're going to talk about today, right? Velocity banking. So let's just go into it right now. So there are two things needed to do velocity banking. We go over this every single time. Number one is a budget, and then number two is a line of credit as our main operating account. And let's just count how much debt we have here. I probably need to re-update this because I slightly modified this goal. So how much credit card debt do we have here? So it's 5 plus 8 plus 15 plus 27 plus 30 plus 7. So that's, whoopsie, false. Whoopsie. I got to put a plus right here. So that's 92K of credit card debt. We add this all up and it's $92,000. So pay off 92K of credit card debt. All right. And then we got car loan, student loan, mortgage, and we got our general expenses. Remember, this is a debt payoff strategy. So if you don't have any debt, for example, you have $3,000 of income and then $3,000 of expenses, this is not going to help you because this is a debt payoff strategy, right? There's two stages of your financial journey. One is you need to make the income, and Dave Ramsey talks about this too, where he talks about you have an income problem. Remember that? And then number two is cash flow and debt management, right? And this is what we're focusing on today. So I think too many people, they're on step one, meaning they need to make more income. And what people don't realize is that banks don't lend you money if you haven't passed that first step. I keep telling this like all the time, and people are like, this is unrealistic. And I say this as a person who made about $20,000 a year, and I paid off my mortgage in the 3 years yesterday. So, people will always complain, but I do like to address it from time to time because I get that some people are new and they don't understand the context in which you would do this. You wouldn't do this on day zero if you don't have the income. Okay, so now let's first pay off our credit card debt and assume that we have a $200,000 limit of a home equity line of credit. It could be less, it could be more. I know people who, because they were in the right place in the right time, who have a ton of equity and they did absolutely nothing, right? Because they were in the right place in the right time. So, for example, my father bought a house in California for $280,000, and now he has a paid off house after 30 years and $1 million of equity. So it's very possible for him to get an $800,000 home equity line of credit at least, right? But we'll just say we got a $200,000, right? So again, we'll have a $200,000 home equity line of credit. If we offer our home equity as collateral, we can get better rates, better limits, right? And some people are like, oh my goodness, if you put your home equity as collateral, that means they can take it. No, duh. You figured out what collateral is. You get better rates and terms if you offer collateral, right? I mean, it's so weird how people think that there's this really safe bubble that you can be in and not have any skin in the game. You ever been in a transaction where where the other person had absolutely no skin in the game? They always fail to perform, right? So it's not a bad thing that you have some skin in the game because you're probably paying your bills and not be a deadbeat. Right? All right. So now we did our budget. We have all of our debts listed, and we have this general section for general expenses: food, gas, insurance, all that other good stuff. Yada yada yada. That's a phrase from Seinfeld. All right. So now what we do is we assume two things. Number one is the same income, and again, don't focus on the income part. Just focus on the concept itself. The reason I put this income is because I always call this a stress test where you make a lot of income and you have a lot of debt, right? Because more money, more problems, right? So we assume we have the same income, but now we're going to do the opposite of mainstream finance, which is zero savings, okay? And then let's go ahead and copy all of this, right? Copy all of this and then copy these expenses, and then we're going to have something called cash flow, which is income minus expenses. Now, you might be asking, what's the difference between this one and this one if they're same, right? Well, this one is going to increase when we make our line of credit as our main operating account, okay? And we haven't made our line of credit as our main operating account. We left it right here. But let me go ahead and start out with these credit cards and just simply move these credit cards to the line of credit. Again, that's $92,000 of debt. And so here we are with about 1,400 in savings, which is not bad. But if you're making almost 10 grand a month after tax and you only have $1,000 of savings left, it's like, what's going on here? But that's because your debt is essentially a big drain on your cash flow, right? So let's go ahead and put $92,000 here. And then what happens to essentially all these payments? Well, they all go to zero. Zero, 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 zero. Oh, not this one. The car loan is not zero. But look how we went from $1,400 to $4,471 in day one without making more money, right? Without making more money. And what's the actual strategy? Well, this income, this whole entire income, goes into the line of credit. Income goes into the line of credit, and this is the actual velocity banking strategy. You put this whole thing into here, you take your expenses out, and then after every single month, so let me just write that here, expenses out of the line of credit, right? And then after every single month, your balance is going to go down approximately $4,471. So let's see how long it takes. Again, we're just going to do that math, basically get the next month, get the next month's balance, which is the previous month's balance plus the previous month's interest, minus this cash flow, which is 4471.22. Oh, how's that false? Well, I keep hitting the equal sign for some reason. And then what you do is you take the interest, which is based on the average daily balance. For some reason, this says sum. I got to redo it. You go here, you click average, you take the 2 of the average, right? And then you multiply it by this interest rate right here, which is about 10%, 0.1, divide by 12, get the monthly interest, and then bam, copy and paste these formulas, copy and paste, right? And if you have no idea what I did, just stop this video, pause it. You see right here, GH plus H, G2 plus H2 minus cash flow, right? And then the interest is average of the two balances times the interest rate divided by 12. Pause it, okay? If you really want to learn, you do it yourself, right? We get good by doing it over and over again. That's how I get so good at this, right? You want to know how I paid off my mortgage under 3 years? Probably because I just practiced over and over again and I made more income, right? No, I know how to manage cash flow because all I do is just dump that income into that line of credit. And so some of you might be saying that's so unrealistic. Okay, well for you it is, but for me, I was making 20 grand a year. Once upon a time, I learned these strategies when I couldn't apply it, and then once I did apply it, bam, mortgage gone in 3 years. So you do what you do, you do whatever you want to do, but because I at first I didn't know, and now I know. All right. So now we go ahead and copy all of this. And then, all right, so now at 23 months, we paid off that $92,000 of debt. So almost about 2 years. So 23 months, 93K of debt. All right. So now we have the car loan, the student loan, and the mortgage. So if you know how to attack this, you could just probably move it into line of credit one at a time. We have so much cash flow right now; it's not even going to matter. If you take a look, this probably takes 6 months or something, right? Again, if you really want to do it the optimal way, probably maybe like chunking will do. And if you don't know what chunking is, it's just moving parts of the loan into the line of credit. But let's just move this 24 grand into the line of credit. Let's just go ahead and do that, right? So I move this 24. Well, it's actually not even 24,000 because it took us 23 months to pay this off, right? So now after 23 months, what's the current balance of that loan? So let's just go to the amortization calculator right here. 24,000 after 5 years, because that's how long an auto loan is, at 6.7% interest rate. And where did I get that number? I looked it up on Google on what the average car loan interest is because, to be honest, I've never bought in a car before. But the idea is still pretty much the same. So what is the balance after 23 months? After 23 months, it's about 15 grand. So let's go ahead and do this, and let's just pay off that car loan. And for simply by moving the car loan into that line of credit, we get $471 back in cash flow. $471, right? So let's go ahead and do that. $471. And then we put this here, okay? And then bam. And now let's get that $471 of cash flow back. This is 0. And then bam. Our cash flow is now almost $5,000. So 4934.06. 4934.06. So what we do is right here is write down 4934.06, right? 4943.06. Let me redo that. I'm going so fast. All right. So 4943.06. And then now we just copy that. And then bam, car loan paid in 2 months. Wow, amazing. This is too good. All right, so now that's paid off. Okay, well, bam. And then now let's do the student loan. So what's the student loan? How many months is this? 26 months, right? So 26 months to pay off 93. So what's 93 plus 24? 117K. Okay. And so 35 months, or I'm sorry, no, 26 months. What's the current balance? So it's 35,000 at 6.8%. So I just go right here, 35,000 at 10 years at 6.8. All right, so now 6.8, 35,000 at 26 months. What is 26 months? So 29 grand. I know I'm going really fast, but I'm actually sleepy too. Gotta wake up early in the morning. Okay, so 29 grand, right? And let's just go ahead and move that into the line of credit. And there's a certain order that you need to do it, right? But usually you do the mortgage last. Credit cards first, then usually auto loan, then student loan, and then mortgage. All right, so we move that 29 grand, and guess what? We get $402 of cash flow back. So this goes to zero. And then now our cash flow is $5,345.84. Crazy. All right, so let's move that here. Okay, so this here is as a reference, and now we got to replace this with 5345.84, right? And so now that student loan was paid in 32 months. 32 months. All right, and then now it's 117 plus 35 as the debt amount. All right, so 152K. And then next one is the mortgage. So after 32 months, let's see what the balance of the mortgage is. 32 months. Give me one moment. Okay, so now let's go to the amortization calculator, fill in the values, $300,000 at 6%, 30 years at 6%, and okay. And then this is at 32 months, 32 months. Whoopsie, I'm at the wrong place. 32 months right here, $289,000. Okay, so $289,000. Now, you might be thinking, because I moved the car loan and student loan to line of credit, why not replace the mortgage with the line of credit? And for most people, this is not going to be the greatest idea, because you'll pay more in interest than just either doing, direct extra payments or doing something called chunking, right? So here's the thing. If you do direct extra payments, meaning that if you have $5,000 left over in your savings account and you put that into a loan, well, because loans are one-way streets, you can't ever get that money again, right? You can't get that money again. And people, that's why people are always afraid to overpay loans. And, anytime there's an issue with their cash flow, they get a letter from the bank saying, hey, you can refinance. That's why, like, people, if people actually did do, like, direct payments, overpayments with loans, most mortgages are paid off in like 5 to 7 years. So what we have to do is just essentially overpay it with the help of a line of credit and prevent something called segregation of income, and still have the same effect without really losing control of our money, right? Because everything just goes in and out of the line of credit. And so kind of think about this, like if we went from 289 to 279, which is about 10K, how long would it take? So how long does 279 take? If we take out $10,000 of principal, if we just follow the 30-year mortgage schedule, so at least 1 year, 1 year and 1, 2, 3, 4, 5, 1 year and 5 months. Oh, so almost about 2 years, right? A little bit more than 2 years, it looks like. But let's just move that 10K into right here and just pay it off with our cash flow. All right, so let's just go here. Let's add 10,000 here plus 10,000. Okay, and then how long did it take for us to pay off that 10,000? 2 months, right? So you could just rinse and repeat over and over again and do everything from the line of credit, make your life a little bit easier rather than doing extra payments. Because again, the system knows that most people won't directly overpay a loan directly with their savings, because most people are thinking, well, what if emergency happens? And they're kind of right, right? Because if you overpay a loan, they never give you back. You can't call them and say, hey, can I get a refund for that? That was a mistake, right? Usually they won't. Maybe they will. Maybe they might do it one time, but usually that's not the nature of the beast. Okay. So I'm just going to compare two situations, right? So one is doing the $10,000 chunks or whatever little chunks that you want, or you can just replace your mortgage with the line of credit. And let's just do a quick comparison. So you just put in the information here in this Velocity Banking Calculator. So $300,000 original balance. And this one here is 289,664.08. 289,664.08. So that's the current balance. Interest rate is 6%, 30 years at payment amount 1798.65. 1798.65. And then we'll say have a 10% line of credit. And what is our income? Well, again, we got more money, but we're not going to have more problems anymore. So 9644.49, 9644.49. And then your expenses is everything except for the loan we're trying to pay off. So it's 2,500 right here. So we don't include the mortgage because the mortgage is already taken into account right here. Okay. And you might wonder, where did I get this calculator from? Well, I got it from Renatus because I'm a student of Renatus, and that's where I first learned velocity banking in 2017. And full disclosure, I actually get commission from selling their educational products. So I do try to share it with other people. Again, I'm a quote marketer, independent contracted marketer. So I do market these products and get a commission from them. All right. So now what we do is chunk amount is just how much we're moving to the line of credit. But one of the things I wanted to share with you is that let's say we replaced our mortgage, our 6% mortgage with a 10% line of credit, 289,664.08. You'll notice, wow, 4.2 years, that's really fast. And look at this, $66,000 of interest paid, and we saved about 234. Okay, well, let's do $10,000 chunks. So 4.2, 66. 3.8, 35. See how much more money you don't, it's faster and you don't pay as much interest. So again, it just could be a small amount. I just like to use somewhere around your paycheck, but let's say we do 20,000, right? So this will probably increase just a little bit, but let's see how much it does increase. Yeah, just 1 grand more, right? So you could do small chunks. I like to use something similar to your paycheck, but 10,000, 20,000, it's all good. But if you'll notice, but if you replace your entire mortgage with your line of credit, 289,664.08, this doubles, you know. And here's the thing: if the interest rate's actually lower, so for example, you're able to get something lower or even the same interest rate, then yeah, you might consider doing it. So for example, let's say 5.5, right? So again, similar, almost similar to doing the chunking method, but the chunking method is almost resistant to the interest rate because if I do, let's say, if $10,000 chunks at 10%, right? So it's 35, but let's say I do a 30%, right? So a little bit more, but not as much as replacing the entire mortgage, right? Entire mortgage, which is 289,664.08 with that entire line of credit, right? So that's why, like, in most cases, most people's lines of credit will be higher than their mortgage, unless it's usually like an investment mortgage, which is about 8%, and you can get 8% lines of credit. But most cases, the line of credit interest rate will be higher because think of it like in the terms of software features. The more you pay, the more features you get. So if you get a higher interest rate, you get two-way access. Whereas with the lower interest rate loan or with a loan, it's a lower interest rate because it's a one-way access street, right? Banks aren't stupid. They know why they can price loans lower than lines of credit because that two-way access is incredibly valuable, yet they don't really want you to know that. They like those low interest rate loans because again, you're making minimum payments over the life of the loan. The minimum payment, yet because the minimum payment is so low and you're doing it for a long time, you don't even realize you're getting the all that interest sucked out of your paycheck, right? All right, well, so let's just go back here. Let me redo this. So let's see, $10,000 and then 3.8 years, whoop-de-doo. And now 32 divided by 12 plus 3.8, 6.47 years, and all debt paid off. So how much was that? It's 152 plus 300, so it's 452K. 452K. All right. So, in the wise words of our deceased fellow icon, Christopher Wallace, more money for the average American usually equals more problems. But when you're doing velocity banking, that's not the case, because if you don't know, now you know, right? All right. So, yeah, well, that's it for today. Just another excuse to talk about velocity banking and also talk about Notorious B.I.G. Like this Atlanta news station. I'll drop a link to this clip down below. All right, everybody, have a great day, and we will speak next time.